Hello everyone, I'm Mike Van Horn, Director of Annuity Marketing here at Financial Professionals Group. Today we're going to look at a brief tutorial on minimum guaranteed contract value and how it works within a fixed indexed annuity. So what is minimum guaranteed contract value? Well, minimum guaranteed contract value, or MGCV, is the worst case scenario surrender value for your contract. So if at any time you were going to walk away and surrender your fixed indexed annuity, this is your worst case scenario. This is regardless of what happens in the market. The contract value will never be less than the minimum guaranteed contract value. Now it'll generally range from 1% on 87.5% of the premium up to 3% on 100% of the premium. So how does minimum guaranteed contract value work? Well, when we think about minimum guaranteed contract value or our annuity, we actually have to think about it as being two separate accounts. So the first account is called the accumulation value. And this account in our fixed indexed annuity is the account that grows based on market performance. When the market is going up, we participate in that performance and we earn money. When the market goes down, we stay flat and earn 0% in that year. So this first account is our actual fixed indexed annuity as we traditionally think about it. And this grows independently of the minimum guaranteed contract value. Now the second account is our minimum guaranteed contract value account. This happens in the background as our worst case scenario safety net. And the minimum guaranteed contract value is going to grow at a fixed rate of return. Like we said, it could be something like 1% on 100% of the initial premium. What will happen is upon surrendering the contract, the insurance carrier is going to compare the two accounts, and whichever account has grown larger is the account that will be credited to the client. So let's look at an example. Here we have an initial premium of $100,000 with a minimum guaranteed contract value of 1% of 100% of the premium. We can see the minimum guaranteed contract value is the far right column growing at 1% compounded each year, and then our FIA, our fixed indexed annuity scenario 1 account, is our accumulation value account. We can also see starting back in 2000 going through 2010, and we'll just assume a 6% cap. So we can see the first 3 years, 2000, 2001, and 2002, well, we received 0% because we had negative performance in the S&P 500 index. So the accumulation value stays flat and even at $100,000. It's not crediting that 1% into this account. Then we have 2003, 2004, 2005, 2006, 2007. All those years we're hitting a cap rate of 6%. So we're crediting 6% compounding in each of those years. We can see the account value growing. Now in 2008, we have a down year again, 0% in that year, and then 2009 and 2010, we're hitting our cap rate of 6% again in those years. And the ending account value inside of the fixed indexed annuities accumulation value is $150,363. And our minimum guaranteed contract value has grown to $111,566. So the carrier is going to simply look at the two accounts. Because the $150,363 is larger, that's what the client will walk away with. Let's look at an alternate scenario. Let's say that in scenario 2, hypothetically, 2003 through 2010 was all negative market performance in all those years. Well, in this case, the accumulation value would not have grown at all because the index annuity would have credited 0% in all years. Therefore, the account value would end at $100,000. So, in this case, when the insurance carrier compares the accumulation value to the minimum guaranteed contract value, they find that the minimum guaranteed contract value is larger than the account value, and that's what the client would take home. Hope this has been helpful. If you have any questions, please feel free to give me a call. Once again, this is Mike Van Horn, the Director of Annuity Marketing for Financial Professionals Group. I can be reached at 877-455-0119, and my extension is 226. Thank you so much, and keep growing.